Well, one thing remains true on Wall Street. When everyone's an expert, no one's an expert. The June inflation report that we got that scared the Federal Reserve, I bet you the second half of the month was much softer on the consumer when you actually break down the numbers. The Federal Reserve themselves, playing catch up in my opinion once again, this time to our neighbors in the north in Canada who had a surprise 100 basis point rate hike this week. And housing, the longer these interest rates stay at these elevated levels, the more the listing prices are going to have to adjust to consumer affordability. Welcome back to This Week in Mortgage, everybody. My name is Sam Battaglia, your mortgage broker here at Guaranteed Rate in Beverly Hills. Hope you had a great week. Well, Wall Street, when everyone's an expert, no one's an expert. These markets have been topsy-turvy, up and down every day with no real basis for the direction other than trading and maybe the robots at this point, because on a day-to-day basis, you just can't tell where it's going to go because it has not yet picked a direction once it hit around bear market territory. But I can tell you this. The stock markets are definitely Pavlov's dog right now when it comes to the Federal Reserve and the word inflation. But the opposite keeps happening. So the Fed signaled a few weeks ago that they were going to go 75 basis points, and they did. And the markets shortly after then rallied. So the markets actually like when the Federal Reserve is going faster because it's actually showing a light at the end of the tunnel. And this could be nearing the end of this rate hike cycle that we've been entrenched in all year, that is basically a coin flip guessing game on what the Federal Reserve is going to do. So when they actually give us direction and they're sure about their direction, the markets then have confidence in them. So after our neighbors to the north in Canada this week raised 100 basis points on a surprise rate hike, our Federal Reserve threw a trial balloon out there that we were going to raise 100 basis points, or that at least we were not scared to raise 100 basis points in our next meeting. And guess what happened? Today's Friday. The market rallied very hard to end the week. So I think the markets like when the Fed has certainty, because that's going to build confidence and they actually know what they're doing. And the stock market, next week, we enter the heart of earnings season. We're going to see if these adjusted values that these stocks have are actually going to line up with the earnings that they are expected to get. So next week's going to be a big tell for the stock market for the rest of the summer, headed into the end of the third quarter. The inflation report that we got is definitely going to be a tale of two halves for the month of June. The first half of June was absolutely brutal when it came to food and energy prices, but the second half of June was actually not that bad. So when we actually get the July numbers for inflation, we're going to get those in August. I bet you that it will show that July looks a lot like the end of June, and inflation probably has subsided because we've all seen the price of gas and the price of food at the grocery store come down a tad bit lately, leaving that hard edge of consumer affordability when it comes to gas, for that matter. So hopefully the month of July's inflation numbers that we look forward to in August will show that inflation is chilling out, and hopefully the Federal Reserve will be done with their rate hike cycle. So when it comes to the Federal Reserve and inflation in the markets, here's the best case scenario. Best case scenario is the Federal Reserve raises 100 basis points in their next meeting in the next couple weeks here in July. Then, in August, we get the July inflation numbers. And as I mentioned, I expect them to look like the second half of June's numbers. If this indeed ends up happening, you will see the stock market and the bond market rally, because the belief will then be that the Federal Reserve can stop raising rates into what some folks are calling the recession, the R word I don't like to use. But everyone will think the Federal Reserve is done and will probably be set up for a decent rally for the latter part of the third quarter, headed into the end of the year. But we will actually see. But people do want the Federal Reserve to be sure and certain, and that's going to create confidence from all markets. Moving on, the Federal Reserve themselves, as I mentioned back on my show on April 6th, I believe they should have went 200 or 250 basis points back then, because again, they're just playing catch up. So our Canadian friends up north, they raised their equivalent of the Fed funds overnight rate 100 basis points. That same afternoon, we trotted out one of our Federal Reserve governors saying that we might go 100 basis points. Well, I actually hope they do, because the markets have reacted positively to that. Stock market today, as I mentioned, rallied, and the bond market has maintained its level for the 10-year Treasury under 3%. Now, that said about the 10-year Treasury, another reason the Federal Reserve is really walking on a wire with no net here is the inverted treasury yield that we're dealing with is actually the deepest inversion we've seen during this cycle, where the 2 and the 5 and the 3 and the 1 month treasury or the 1 year treasury are all trading higher than the 10-year treasury. So the Federal Reserve headed into our next meeting, if things remain the same, we're going to be staring at a deep inversion, which we've all discussed is a sign of a recession to come. We're going to see how this shakes out. And then I said, they should have been raising more earlier because that would have instilled confidence in all markets that the Federal Reserve would have signaled that they actually know what's going on and that they're actually in control. What markets don't like is when they think the Federal Reserve doesn't know what's going on and the Federal Reserve isn't in control. So that's why, counterintuitively, the markets keep rallying every time the Federal Reserve says they're going to raise more than a traditional 25 or 50, or maybe now a one-time tradition of 75 basis points. The markets actually like it because it creates certainty that the Federal Reserve actually knows what they're doing. And I have another thing. I wonder if there's a Federal Reserve meter confidence survey, a gauge on how the consumer and how Wall Street and how the general public feels about the confidence behind the Federal Reserve's ability to basically run the economy. I bet you if that number exists, when those numbers got to the highest point, if there was a Federal Reserve confidence number equivalent, when that number got to its high point, I can almost assure you, you also saw the stock market during that era also hit its high point, because what stock market's like is certainty, stability, and they need a lot of confidence to put those two things into play. Moving on to the housing market, very interesting time right now. We've been sitting at these higher mortgage rates for a few months, and I'll tell you, the beauty of the housing market the last 2 years headed into this year was that everything was absolutely affordable. So people with big eyes actually had the appetite to match their big eyes because they could actually afford, once they had the down payment established, what they were looking at because rates were so low. Now, in turn, we've had higher rates for a little while now, and as I mentioned, the longer these rates stay elevated at these levels, the more home values and listing prices are going to have to adjust down to actually meet the reality of the consumer's affordability. So we're heading into about 3 months now of these much higher rates, I'll call them, than before. It was a fast tick up to this, but once we established our high point, we've been here for a little while now. So we will see how this shakes out. The good news, housing, my favorite part as always, mortgage loans are performing within a means of a margin of error. So that means that things are remaining liquid. And once again, according to that, what happened back in 2008 and 9, the Great Recession, that was all started by housing, will not happen again. Okay, everybody, that is my show for this week. I hope you enjoyed it. As always, if you have any mortgage-related questions, please don't hesitate to reach out to me. I hope you have a great, safe, and terrific weekend.